Hi, I'm David Stein of Money for the Rest of Us, and in this video I explain why you should stop investing on consumer peer-to-peer lending platforms like Lending Club and Upstart. So I've been investing in peer-to-peer lending since 2006. I started with Prosper, and later I had accounts on Lending Club and Upstart. I have over $30,000 at one time invested in these platforms in loans. I would choose loans one by one on Lending Club using filters. And with Upstart, they didn't allow you to choose loans, so they just chose them for me. Lending Club's done fine. My returns have generally been, and most of my loans were done in 2015, 2016, the returns have been 6 to 8%. Upstart, not so good. The returns for the loans that were made in late 2015, returns only been 3.76% annualized, which is much lower than what Upstart forecasted. They said the return should be around 7%, and they still say that on their website. What's also interesting, if you look at all the loans on Lending Club, and you go on their site, and they have really great transparency. You can see how different vintage years of loans have done. And from 2009 to 2014, the average return across all loans was 7.2%. But look at this graph. The loans that were issued in 2015 and 2016, the returns have dropped. There's a much steeper slope. In fact, the overall return across all loans for 2015 issued loans was 4.4%. And for 2016, it's 4.1%. Now, you would think if returns were dropping for individual investors, that interest rates charged to borrowers are going up. But if you look at this graph, interest rates have stayed the same. There's been a structural change to the peer-to-peer lending market. Upstart, Lending Club, and other platforms have found that they can raise capital through the institutional marketplace, institutional investors, using what is known as securitizations or asset-backed securities. Asset-backed securities are essentially bonds that are backed by consumer loans. And what they do is they break it into different tranches. The A tranche is the highest rated loans, and then it goes down to B, C, and D tranches. These tranches, or these asset-backed securities, are rated by rating agencies. And what's interesting is Upstart issued their first asset-backed security in 2017, and they just did one a month ago in July 2018. It was rated by the Kroll Bond Rating Agency, and Kroll estimated that this package of loans, over the life of the asset-backed security, the net losses would be between 18.3 and 20.3%. That's pretty high. Now, when you look at the yields on these loans, they're yielding 0.9% to 6.4%, the yield on the bonds, that is. And so how is it that an investor in an asset-backed security is only expecting about a 6% return for sort of the higher risk tranche, yet losses are expected to be potentially over 20%? Well, here's what's going on. This is sort of the magic of asset-backed securities. They have credit enhancements. They take steps when they issue these bonds to protect the investors. There's protections that you don't get as an individual investor on Lending Club or Upstart. And there's three main ways that they enhance these credits or protect them, provide a financial cushion to absorb the losses. The first is what is known as subordination. Subordination means that the first losses go to sort of the higher risk junior tranches. So they take the first losses, and the senior tranches, the ones that are higher rated, the ones that have the best loans in them, the individual borrowers with the highest credit rating or credit scores, they get losses last in terms of the allocation of losses. So you get this subordination effect. The other thing you get is what is known as over-collateralization. The Lending Club, Upstart, and other platforms, they put more loans in the pool more than the face value of the bond. So there might be $110 of loans for every $100 of face value of the bond. And so since there's more loans for each dollar of bonds, there's that additional protection against defaults because it's creating a more interest to absorb some of the defaults. The final thing they do is they set up a reserve, essentially a cash balance about 0.5% of every loan in those asset-backed securities to protect. And then as loans get paid off early, that cushion is still there for the loans that are there longer and potentially default. Those three credit enhancements means that institutional investors are willing to take a lower yield on those bonds, and it means that Upstart and Lending Club don't have to charge as much to borrowers. So if you're a borrower, that's a good thing. But if you're an individual investor, your returns are lower because you don't get those credit enhancements. The returns have been 4% or so for 2016 loans, and if we hit a recession, the returns will be even lower. There are better options if you can invest in that you don't have to tie up your money for 3 to 5 years, potentially to earn 4% or less. You can buy an ultra-short corporate bond ETF that yields 2.5 or 2.6%, and there you can get your money immediately. So you don't have to wait around. And as a result, I don't think we should invest on these platforms anymore. It used to be fun, used to get much higher returns, but you don't get those type of returns anymore because now we're competing with institutions that have these additional credit enhancements, so they're willing to accept a lower yield. One other thing that the Peer IQ, they do a quarterly update on what's going on in this asset-backed security market for peer-to-peer lending. And they point out that defaults are definitely increasing. That the bond investors have been protected because of these credit enhancements, but defaults are increasing because there's more competition among the different platforms. They're willing to invest or lend to riskier borrowers, and we shouldn't play around in this space anymore. Hey, if you have any questions on this, you can leave those in the comments. Thanks.